Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. We have a return guest for you today, Lauren Saidel-Baker of ITR Economics. You got it. We're talking economics, and we're talking deep economics as we go all through the presidential cycle, everything that's happening in the world of geopolitics and how it could affect you as a real estate investor, and for the second time, what's coming in 2030 and how to prepare for it. Let's get to it right now. This is episode 356 of Zen and the Art of Real Estate Investing with my return guest, Lauren Saidel-Baker. Lauren is an economist at ITR Economics. She's also become a public speaker, which she never planned for, which we went over on the first episode. Her last episode of this show was episode 234, Unbiased and Apolitical Economic Forecasting for Now and the Future. I know we're going to get into that and much more. Lauren, welcome back.
Thank you so much for having me back. So great to be here.
Yeah, I'm excited to talk to you again. And I know when we talked last time, we were kind of like figuring out what was going to happen with the new administration. But how hard is it as an economist when things are just in flux a lot, when you don't really know if what's going to happen is going to happen and you have to kind of work along with that? I'm sure that's difficult.
You know, it's difficult, but it's also what makes my job so interesting. Yeah. So I won't complain too much about it. Obviously, we wish the crystal ball was always perfect, but we can usually find some precedent. That's where I am even now. I'm sure we'll talk oil prices. That's top of mind for a lot of folks. But even something so seemingly unprecedented as this conflict with Iran, we do have some precedent. We can look back at past examples and kind of get a sense. And even when the big example I always go to is COVID, that was completely unprecedented. But we put it in a different framework. We said, all right, what is this like? It's kind of like a natural disaster. And so we looked at major natural disasters and what the recovery from those looked like. So we always have something we can use in the leading indicators. But you're right, it's a very turbulent time out there right now.
Yeah, I remember you did say that on the first episode too, something to that vein, like you have so much historical context to pull from that you can at least use verified examples. And because you're always judging everything, you can get to these high percentages of predictions. But it still must be interesting to see something happen. And then, you know, I guess people expect reactions because that's what the new news cycle is out. But you guys are not in the business of reactions. You're talking long-term forecasting.
That's really our goal. That is what, we always do proactively report, and you can go right on our website and see what is our forecast accuracy for various series that we do predict. The thing that I really stick to the most is not those, 98, 99% accuracy levels, but it's how long was that forecast in place? Right now, all of our major ones, I'm talking GDP, industrial production, retail sales, right? The big things. I believe all of our top 10 are over a year. Most of them are pushing a year and a half or 2 years at this point. So I think of that as good news. Maybe, we're not exactly in the middle of the dartboard, but we're within a percentage point or two. And it's giving businesses that ability to plan, because if we are just changing, all right, new CPI numbers are out, everyone change the whole forecast. New retail sales just dropped, change the whole forecast again. You can't plan for that. You can't use that to make business decisions. These have to be looking longer term. So that's why our methodology is what it is.
Yeah, I feel you guys are the perfect balance to the news cycle, because when I look at it, like you said, I can look at it at 2030, which I know we're going to talk about, and we talked about in the first episode, say like, okay, I need to make some plans just to make sure I'm good and I'm setting things up to expect that, because it's not going to hurt me to make the plans that way. But as opposed to the news cycle, which is just like every day, it's like, what's happening today? How's that going to affect tomorrow? but all real estate investors, all investors, and all people who've done well over the long term are always focused on that long horizon and planning in advance. And that's where you guys can come in and really help.
Exactly. Yeah, we're not in the business of selling newspapers. So the snappy headlines don't help us very much.
Yeah, no, not at all. So what have been the main drivers in 2026? You obviously mentioned oil prices right away. Is that the number one that jumps out that is kind of driving economic forecasts? And also, yeah, wondering when's that going to stop or when's it going to adjust is like you said, historically contextualized, you can do that, but still, I don't know.
Yeah, it's, I wouldn't say oil prices specifically, but I think that's one factor within the broader category that we're watching right now, which is inflation. This is true both on the consumer side, on the business side. If you look at the PPI, I think oil prices are a very noticeable way to see that, right? You notice what that price is at the gas pump. Everyone knows. Whereas some other inflationary pressures, which are actually driving inflation much higher, they're a little bit more behind the scenes. If you just think about how much liquidity is out there driving prices higher, right? The boring stuff, the velocity of money, the money supply. I mean, who's following M2 money supply versus who's looking at the posted price per gallon? It's very different. We see inflation rising, and I know we talked about this last time. It seemed like oil prices, the whole conflicts with Iran were just meant to prove us right at this point. But the other factors are still there. These are wage pressures. We still have a pretty tight labor market that's keeping that upward wage cycle. And as far as oil prices go, I mean, like I said, we do have past precedent. I think one of the really good precedents in this case is actually going to be the Russian invasion of Ukraine. Because if you look back to what prices did at that time, they spiked higher. There was that risk premium, right? That the trade went on to commodity prices. But then, even though we're still seeing that conflict, it has not been, closed and ended. Yeah. We did see oil prices start to normalize after that immediate invasion time. So that's what we're looking at for something like Iran. I think we're going to see a short term and probably, second quarter of this year looking to be the high point for pricing before calmer heads prevail, right? Maybe the Strait opens, maybe it doesn't. We have this will they, won't they ceasefire. But the markets are going to adjust. We're going to see that trade, again, maybe not come down to exactly where pricing had been, but moving in that direction. That's what tends to happen over the longer term. So I'm taking some comfort that I think this is a short-term spike. However, I also want to go back to everything else I just talked about with inflation. This is not the only thing causing higher prices. So say the war ends tomorrow, magically, we could all hope. I don't think that means inflation goes back down.
Yeah. Yeah, but there's so many other factors at play. And I think sometimes, your regular real estate investor who owns a couple houses here and there, they own their personal residence. They think, well, I don't really need to be concerned geopolitically with what's going on. But it actually does play a role in the future values of potential real estate and geographically in the United States, what's going on. So do you think, I know I was saying this in the pre-show, how does someone who obviously they can rely on ITR Economics and you for that higher end. But for some people, when they're just, like you said, they're at the pump, that's noticeable. Groceries, to me, I don't look when I order my groceries because it's just so ludicrous than price now. I'm like, am I getting something new? That's just crazy. How do they start to get like a little bit of like economic information that can help them? That's kind of more viewable to them. That's a little bit not so wide, I guess.
So the big two competing factors here are going to be how inflation passes through to interest rates on the one hand, because clearly those are not just the rates you're getting, right? The rate on your mortgage, all of those factors will influence real estate markets, but also overall consumer affordability. That's something that has felt very pinched. I'm going to start with I don't want to call it the easy one, but probably the quicker answer, which is how those interest rates will be adjusting. We have a new Fed chair who's shown more dovish inclination. So whether that's more rate cuts or just holding rates at this level, I think that's a harder and harder thing to do as you see inflation tick higher. No one on the FOMC wants to see inflation get out of control. Yeah. So for him to be able to, even if he wants to cut rates, to build consensus, he's just one vote on that committee. So to get everyone a majority, right, to vote to cut rates, I think that's going to be a hard challenge. Again, we have been watching inflation, worried about rising inflation for so long that I've been saying for probably 6 months now, I would not be completely surprised if the next rate move is a an increase, not a decrease. And the market is slowly starting to come around to that point of view. We're seeing the odds shift by year end. There are actually greater odds in just market, kind of market predicting forces, greater odds of a rate hike compared to a rate decrease from this point forward. So keep in mind what that does for mortgage rates if you need to lock in financing, right? That's going to change the calculus. Not a ton. I'm not saying rates are going, crazy high, but I certainly wouldn't be waiting on the sidelines for another even 25 basis points of cuts. This is going to be a very, very small move if we do get a move down, and I am not looking for that move down.
Yeah.
Now, on the other hand, that's also going to influence general, first of all, consumer sentiment. As everyone feels more and more pinched, they get pessimistic. And that doesn't tend to influence our day-to-day spending. So I don't think that, say, gas prices are so high today that someone was going to drive to the store, they stop and get gas and say, whoa, that just costs so much that forget it. I'm turning around and going home. I'm not going out to buy whatever I had been. We're not there yet. They're still going to be in those habits, do that same day-to-day spending. Like you said, the grocery store, the retail, that type of thing. Where we do see them pull back is on the big ticket purchases. So autos are a big one and homes are another big one. When you don't feel good, you just don't want to spend that much money, especially with rates where they are, and especially with housing affordability quite so strained. I think that's going to do good things for the rental market in the near term because people have to live somewhere.
Yeah.
But that affordability pinch, it is getting really bad in some areas, especially coastal states. It just costs so much to afford the average home, the average mortgage rate, right, with all of the taxes and insurance. We're really seeing that outstrip incomes in many ways. So the challenge is knowing what part of the market to be in. You've probably heard the term K-shaped economy, where the upper end is doing quite well right now. The lower end is feeling the pinch more and more. That means that even within the same market, you can get very divergent trends. It's more incumbent on the investor to really lock in to where the opportunity segments are going to be.
Yeah, that makes sense. And I think overall, it's so hard to judge because, it's a large scale economic forecast for our country, but real estate is always local. So you have to know your local economy and how it's reacting and what building is like in your area and what the markets are like, buyers or sellers. You really can't just rely on the headline like we've been saying. But also, if you go back and look at it, where you started this part of it with the rates, I did hear that just yesterday that there's just as big a chance that they're going to go up. But I mean, it's not going to be much either way. So I feel like it's almost like we were saying, news hysteria about like a quarter point that shouldn't really knock that many people out of the market. Could it knock a few out and bring a few in if it goes? I mean, not really. It's just like you said, it's really a mindset thing and how you're reacting, because I was responding to like an article for, I think it was for CBS or something. And they were saying like, oh, what's going to happen if it goes down a quarter point? I'm thinking to my head, I mean, nothing really. It's just about what they really think about that. And if they're incentivized to do anything. And if people are choosing to stay on the sideline, maybe that's a good choice right now. But historically, mortgage rates are not high. That's what, I mean, I don't know why you, of course, with when you look at the historical background, I mean, I guess they're high for younger people, but for like people my parents' age, these rates would be pretty solid.
I know you're going to get that generational. Back in my day, mortgage rates were 20%.
And
right?
I really feel like a boomer.
Totally fair. I know. But so I'll use myself as context. I graduated college in 2011. That's when I started looking for my first home.
Yeah.
I got great rates. Right? Rates had been low from that point on in the wake of the last, the recovery from '08. So in my world, yes, these rates are relatively high. And especially I see this in my younger coworkers who are just now looking to buy their first homes, right? They just got that first good job and they're excited and they want to, set roots somewhere. And they look at me and I'm like, hey, my first mortgage rate was sub 3%. And they're going, man, I missed the boat, right? Should I wait for them to go back down? Luckily, we're economists, so they are not waiting at this point. But I hear this from so many young folks that say, what a loser I was wasting my time in the 5th grade instead of buying a house. Missed the boat.
Yeah. But I think it's funny that people, they only think of the purchase time instead of they think of purchasing and, oh, if it goes down in 2 years, down 2 points, and I have a sweet refinance, what I call the double windfall, where you have all the appreciation that you've made over the time, and then the windfall of the rate coming down. So your payment goes down and you can pull money out or buy another property. It's like, I don't know why people don't think it. It's the same thing we've been talking about, short term versus long term. If you're thinking long term, like, well, any time's a good time to buy if I can afford the house, even if it's, you try not to stretch it, and then see what happens with the rates. They can always come down later or stay steady, or we can't control
or go up. Yeah.
right.
Right. That's
right. And then you're in good shape.
Exactly. Then you wish you had, right,
Yeah.
made that loan back when rates were lower. And, I see this all as finding the right opportunity, especially with something like a home. It just matters so much more. Is this the right house in the right place for you, for your situation, for your time frame, compared to, as you said, 25 basis points? I hope that's not making the difference for anyone.
Yeah.
It shouldn't be.
I think sometimes people can use it as a crutch to say no, like,
Right.
they went up, so I'm just going to pass, because maybe they were nervous about buying a home anyway, and then that's you just put one little cherry on top of the sundae for them to say, oh, it's too much. When really, like, it just changed your payment, $43 a month, which it can be substantial, but it's not that substantial where it should knock you out. And one thing I've been saying, I don't know from an economist point of view, but I feel like people have always been looking at homes that are too big for them anyway. The kind of forever home idea, if you don't have kids and you're buying a 4-bedroom house, why are you doing that? Well, we want to plan for the future. Yeah, but you don't have to buy real estate that way. You could be smarter on a long-term buy and trade instead of just buy and hold, which both strategies are good. Has that ever come up as something? I mean, it's kind of hard to do data on that, but I can see that the time that people are staying in homes is becoming longer now.
Yes. And, really where we've looked at this is actually on the other side of the equation, the builder side. Because as much as we're talking about, all right, 25 basis point move in rates, that's not going to move the needle. But we did actually see a large move, several rate increases back to back to back after COVID and that kind of next recovery cycle. In that time frame, that's when it did make a difference, right? When mortgage rates went from 3-4% to 6-7%, that does price people out of the market. And that's what we saw back in that last, kind of 22, 23, even into 24 cycle. That really depressed a lot of home buying activity. But what didn't happen, interestingly, is it's like the builders didn't get the memo. And so we still saw them building, first of all, a lot of homes. So there's a glut of inventory in certain types of markets. But really where I see the mismatch is these were just the wrong types of homes. They were either too big, because you're still thinking people want those big footprints, especially as during that time, talk about inflation. All our building costs went up. Wages for the builders went up. All of the materials, right, from the drywall, especially the lumber, with what lumber prices were doing back then. So they said, well, if I want to get my profit, I need to build a bigger home. And they were building them in the wrong areas. Maybe some of those more desirable downtown neighborhoods, they've already been filled. So you've got to go further out. So we saw this really interesting market dynamic that I don't think we've ever seen quite this way before, where people do want homes, but they want smaller homes, more affordable homes, maybe better located homes. And that's not what was being built. So it's interesting to have both a glut of inventory and a dearth of inventory in just slightly different areas of the market. I think that really hurt the housing market. We haven't seen a full readjustment back from that trend quite yet. I think that needs to happen. And a few of the indicators you mentioned, you want viewers to be able to follow along as this trend progresses. One thing I'm watching is just the square footage of new homes constructed. That's a data set that's publicly available. And you can see homes are overall getting smaller. Even with, our idea, right? If I can go bigger, I want to go bigger. But over the averages, we are seeing square footage shrink. And I think part of that is to bring the cost down. If I need fewer windows, fewer feet of floorboard, that's going to put this back into my affordability range.
Yeah, that fits the K-shaped curve as well. Like maybe the $10 million and up are still going for 46,000 square feet, but your regular home buyer, and maybe it's a help to them because you didn't need that much space anyway.
Right.
It's interesting for them to try to figure out, they're cutting costs. How much can they relay it to the consumer? Because their costs are higher, of course, with the straight close. They're missing some items. But that was similar in COVID too. You eventually figure out other ways to get things when you have to.
Absolutely.
Hey, it's Jonathan. I hope you're enjoying this episode with Lauren as she's back. It's not all doom and gloom. It's preparation and understanding of things that you need to know in advance. Now, at the end of the show, if you go down to the show notes and look for something called special link, that's going to link you to where you can find all the good stuff on ITR Economics. Let's get back to the show. All right, I know we have to talk about this. I want to know how AI is impacting your forecasting, because it's very, very interesting dynamic with how it plays in the stock market in terms of like who's really, running the index funds, 6 to 10 companies maybe, and how that's affecting the economy, and still how a lot of people are predicting a pretty big bubble or bust coming in the AR market. And I can see both sides of the coin there.
Yeah. All right. Here's the part where I'm going to sound like the boomer, but I am such a curmudgeon about AI. I think it's incredible. It can do all of these amazing, wonderful things. But anytime I hear AI is going to do this, it's going to replace this many jobs by this year and do all these things. I want the evidence. I just say, all right, show me the proof. Show me, yes, it can do these cool tricks. Amazing. Great party trick. But what I'm really following from a labor market point of view is just productivity. We have measures on output divided by man hours, and we can clearly see over time, are workers getting more productive? If AI really was like replacing all of this work and doing all of these things for us, we would see that productivity curve tick up. And to be clear, it is improving for overall industry. However, that pace of rise, you kind of have to squint at the chart to see a materially different slope than we were on. And if you go back to something like the 90s, which keep in mind, this is precedent. This was the advent of internet, computers, right? Like personal computers, all of those things, much, much steeper slope to productivity gains. So I don't think AI is this incredibly new dynamic that we've never seen precedent for, that we can't possibly plan around.
I agree.
I think we should use even a slightly lower case compared to what we saw in the 90s. And the best example I have of this is actually manufacturing. Again, they made so many gains. All of that low-hanging fruit was picked in the 90s when manufacturing got so much more efficient in the US. Now, manufacturing productivity, even with AI, it's actually moving backwards. We are getting less productive on a man-hour basis somehow. So I think there is more to be done here. I think it's going to be great for the companies that can adopt it. Right now, that tends to be bigger firms and in obviously very select sectors that are really making those investments because it is costly. But it's just going to take more time, and the winners are really going to be winners here. But economy-wide, I just don't see it really moving the needle.
Yeah, I've seen more, I wouldn't say backlash, but more, hey, oh, actually, we made a mistake. We can't dehumanize that entire role. I'm seeing it a lot for, HR or customer service. Like you just can't outsource everything. And I think over time, it's going to keep going back and forth. And I think what people forget is there's always a negative connotation. Like, great, cool, AI is great, but now there's huge backlash everywhere. Nobody wants a data center in their backyard. And that's not even like NIMBYism. I don't want it in my backyard. I like AI, but I'll do without it if I had to have a data center nearby and it was going to, buzz all the time and my water pressure would go down. I mean, these are real concerns that communities have that I think are, you're already seeing them backtrack on some of the square footage of these monstrosities.
You really are. And again, data center construction, that's over $40 billion annually at this point. So it is large. I mean, that is a huge opportunity for construction if you can go into that space. I don't think that bubble's due to pop anytime soon, but where we're actually seeing a much greater impact is in overall manufacturing construction for related things, computers, electronics, electrical equipment, that type of thing. Even power generation. You mentioned the water factor, but man, these facilities suck up power, and that's bringing up residential rates. So I think, again, back to inflation, just another energy cost that's going to be creeping up higher and higher. We're going to need new either grid investment or something. Some of these data centers, they're now turning to their own primary power generation because they just can't draw down enough from the grid at this point. So amazing opportunities if you can be selling into that space. But again, I think the pushback is starting to get a little bit more vocal. And yeah, you're right. No one wants a data center in there. So I'm based in New Hampshire. We've seen outright protests against proposed data centers.
Yeah, and New Hampshire's like a state where just do not even try it. It just seems like that's just not, it's not the spot,
We're quite vocal.
Yeah. I mean, yeah, I just can't see it.
Yeah.
Yeah. But so when you're looking at AI, it's the comparison to the internet really makes sense to me because I kind of see it that way too. It's like, oh, the internet is great. It's going to provide us so much. And then you realize, 15 years later, half the people are spending half of their workday on the internet, just goofing around because it's available. Similar thing can happen with AI. Is it giving us a lot of, new tools that can help us? Sure. But also can now can AI be your shrink and your best friend? Yeah. And then it's going to dehumanize things. So there's a lot of different costs for what can happen from it.
Yeah, I definitely, I use it, right? I'm trying, we have it, in my company, they've been really making an investment there, pushing us to be more efficient, find out how you can use these tools, right? Training and all of that. But I'll go into it and I'll have ChatGPT write an email for me. I'll read it and I'll say, well, that sounds like it was written by ChatGPT. I'm going to rewrite it myself. And am I really gaining anything here? Am I really being more productive? Again, some of it's adoption, right? If I was better, then I'm sure it would be better to me, but I'm just not there yet, to be honest with you.
Yeah. I'm getting better purposefully, but I think for me, it's like all in how I'm prompting it. If you want it to say something, it's going to tell you whatever you want. And that's the slippery slope that I think people are finding, especially though, I mean, to relate it to economic forecasting, a lot of people are going to say, hey, well, let me just talk to the computer about what's going to happen, in 2030 or what I should do in the next year. And it's not necessarily based on the entire world and what's going to happen. It's based a lot on what you've fed into it before and could completely make a plan for you that doesn't make sense if you're not looking at outside factors.
You do have to be careful. You do have to sanity check it, certainly. And, does this really make sense? Or is it just saying things that sound like they make sense on the surface? I think that's a real danger. And again, it is getting better. But for these high stakes decisions, that's where I'm having trouble trusting it.
Yeah, it makes sense. So what other factors are you looking at that are influencing what's coming in 2030? We touched on it a lot on the first show, maybe for a quarter of the show, but I really want to bring it back to people's mind because we were saying like you really need to make a plan for 2030. What should people be looking at now and what's influencing what has stayed a very core prediction for the last year and a half?
Yes. And to be absolutely clear, here at ITR, this has been a core prediction for us for more than a decade now. And we haven't moved that timing. The big driver, in case folks want the quick down and dirty of the forecast here, the big driver is demographics. We are just seeing our population pyramid, essentially. It reaches a pinch point in 2030 where we are seeing healthcare costs draw down instead of, the baby boomer generation, especially. They're going to get very, very expensive in those end years of life. They're not paying into the system anymore. All of that medical spending, it's going off of your private insurance, your employer-sponsored plan. It's going onto the government books. That's not the only thing. We've got Social Security, we all know Social Security is in trouble. Everyone my generation, they say, oh, I'm not going to get Social Security. There's no way.
I just told my financial planner, just take it off. I'm not, let's pretend like that's not going to happen.
It'll be nice if it does, but I don't think we can bake on it.
Me neither.
Our age. And so that's going to be another just major, major cost that we already know is a problem. No one's doing anything about this. So all of that government kind of load really reaching these end years of the decade. Keep in mind, it's not like we're coming from a net neutral position. We already have a massive, massive debt burden. And as rates, I've told you, my view is up, not down. As rates are going up, that means our government has to pay more on the interest, right? Our debt is essentially the principal that we have outstanding. We have to keep rolling that over. Debt matures. We have to keep funding it. And so our interest burden, that is just huge at this point. It is the most rapidly growing major government expense.
It's unbelievable.
It's now pushing the Department of Defense budget. I believe it's actually exceeded the DoD budget. We'll see if Iran brings those back into the race to the race higher, I guess. But there are just so many spending factors here. I think by the end of the decade, something has to give. And whether that's like our creditors losing confidence in us, maybe, I don't know if it's going to be a failed treasury auction. I don't know exactly what form it takes, but something has to give. We can't just keep spending and spending like this as if, that we can keep writing checks and never have to pay the piper at the end of the day.
Yeah.
Eventually, this becomes a problem. And I think 2030, with that demographic tipping point, that's when it really becomes an obvious problem to us. So
Yeah.
we have been saying something major will happen in the economy around those years. That's why, I do hope folks are coming up with a plan to be a little more conservative, maybe to have some just slightly, certainly I wouldn't want to be over levered headed into the end of the decade, but some plan for a more conservative asset positioning, I think will serve very well.
Yeah. One thing we talked about was between now, which was was 5 years and between, and now we're at, 3.5, 4 years.
Mm,
Make as much money as you can so that you're if you really have to hustle it out until 2030, like this is the time to do it because it's just going to be harder then. So if you can get raises and put in, maybe save the vacations for later, because I came off of that recording thinking, build more on the foundation, just keep building the foundation, make sure you're looking at, recession resilient asset types that can do well, or at least will do well until 2030. And then you'll at least have the benefits of that.
right.
I really took it into account. I hope other people did too. But yeah, if you're just a regular consumer now, is that part of it?
Yeah.
Spend smarter, save more, work up the ladder instead of trying to get to the FIRE movement. Because if you go to the FIRE movement, 2030, you may not have anything to do, but you may not have any money left.
Yeah. I think, and again, there are recession resilient industries out there, right? There will be things that do either okay, that tread water, or even grow during that time. But you don't want to be in something highly speculative at that point. I don't want to be, I don't know, triple leveraged tech stocks at that time. That seems like a very risky proposition. So I'm not giving financial advice. I'm not telling anyone to pull out of anything, especially yet. But I am saying just have a viewpoint to that. How would I get more delevered or more de-risked if I really needed to?
Yeah. Oh, I wanted to go back on one thing. From an economist point of view, is it worrisome that basically the stock market is like 10 stocks?
So from an economist point of view, no, not at all, because the stock market is not the economy. From an investor point of view, you might have greater worry. But me as an economist, honestly, the stock market is irrational so much of the time that I'm not going to predict it ever. I'm not going to lose sleep over, especially like a day-to-day swing. My husband always comes home and he goes, "Did you see what the market did today?" And sometimes I say, "No, I didn't." I was not even paying attention because, I was looking at retail sales, or I was looking at the unemployment report that just came out. Those are the actual economic fundamentals that I want to be focused on. The stock market matters for other reasons. And I do think, yes, that's a risk anytime you get greater concentration. But for the economy, nah.
Yeah, I think I heard somebody give the advice that the best thing to do with your stock account is to change your password and don't tell yourself what it is for a year at least. So just don't worry about it. Just let it. I actually learned that lesson though, because in 2008, I was so nervous. I took all my money out of stocks and just left it in cash. It would have had twice as much if I just let it ride. But I learned the lesson, and now I just let a majority of it ride.
That's the problem. We're emotional creatures. Yes.
Well, and again, you're thinking, well, if I make a little move now, it'll benefit me, but it's not. Like I've just seen the cycle and seen what other people are doing trading. And then I look at my account, which is just, index funds, Vanguard or others. And it's just, I'm up 18% in the year, and everyone's thinking, oh, it's such a terrible year. I'm like, I finally learned something, But one of the overriding things that I always hear you say and go back to is that there's historical evidence for all of this.
Right.
It's happened before. Maybe it's a little bit of a different form, but it's out there. There's precedent for all of these things, and might it be a little scary because we're in it and we weren't there for the Great Depression? Yeah, it feels a little bit of a weird, but it shall pass.
Right. And even in the Great Depression, I mean, a lot of people made a lot of money. If you're willing to,
yeah.
and you had to be, again, talk about uncomfortable. You had to be buying at the low when things felt like they would never recover, right? The sky is falling and this is end times. But where I'm seeing this, come 2034, 5, 6 timeframe, if we're at that low point, then to be buying properties, equipment, entire companies, they're going to be going for fire sale prices. Wouldn't you want to have property equipment companies on the upside and ride that next wave higher? I mean, that's the real opportunity. That's why I know some of your viewers are going to be saying, why are they sitting there grinning like idiots and talking about a depression coming? And that's exactly why, because depressions do bring opportunity if you're willing to follow the road signs and, again, find the timing. Don't catch a falling knife. I think this depression especially, it's likely to have a few false bottoms. So things kind of fall, level out, and then keep falling instead of heading back up again. That's going to be a dangerous time. That's when you really, really just need to know what leading indicators can you be watching for. But when that ultimate low does come, man, it's going to feel so bad to do, but you're going to have to if you want to get the upside.
That's what's going to be the restart. Somebody has to take it. So if you have it available, it's going to be a good option. Geographically, at least for the United States, is ITR able to kind of make predictions? I know you guys have a webinar coming up soon. That's kind of a bit. I think it's in like a week. And it's about geography of America as we look towards 2030. What type of things are you looking at geographically? Like, is it big cities, small towns? What should we be on the lookout for?
Oh my goodness, I'm so excited about this webinar.
Yeah, I'm really bummed. I keep refreshing it and like, oh, when is it? I think it's next week now because we're recording on June 9th. So this may come out and you may have missed it, but if not, go on the site.
The good news is we actually have the webinar coming out, and then we have a live replay with live Q&A. So there are cool. 2 chances to catch it. And even if you can't make either of them, we are putting out just the recording. So if you just want to follow along later, you can always send in questions if you do have them after that. This is going to be so much fun. My colleagues Grace Schatz and Connor Lokar are putting this together, and our whole team has been working on it. So I have to admit, I haven't seen the full body of research, but where I've been focusing a lot are just how the population trends are shifting. Where do people want to be? Where do they not want to be? To some extent, it's very state dependent, even more so than the metro area. You get some pockets like Chicago, for example, that can just bring down the entire state of Illinois because that city is feeling so much pressure. Looks like Chicago might be on the recovery end of things. They're flattening out. I know my coworkers in Chicago are saying, no, it's getting better, not worse. I'm into multifamily syndications there and they're doing great. So I'm just going to keep those fingers crossed. Hard to believe, but apparently it's turned the corner. But the perennial winners, they've been places like Texas, Florida, the southeastern U.S., the Mountain West. Trendy places that's bringing in younger workers, which creates that workforce. I mentioned earlier, the labor market's relatively tight. So where you can get young, skilled, educated workers, that's bringing in businesses, which then bring in jobs, and it becomes kind of this virtuous cycle. But otherwise, we are looking at just what do these states themselves do, right? Do you have huge unfunded pension liabilities? That's going to be a downside headed into this massive, again, federal government kind of crisis time in 2030. What resources do you have to fall back on? What does your industry look like? Some of these states are actually pretty well diversified. Everyone thinks American manufacturing is dead. That is not true, especially like places like North and South Carolina. There are just great opportunities. There's great growth. Companies want to be doing business in the United States, and they're finding those opportunities, but not everywhere, not in California. Somewhere like California, man, that affordability.
Bad migration trends there.
Oh, really not good. And it's just driving people out of the state because cost of living is so high, only going up. In this relatively remote world, why do I need to live there if I can have, acreage and a white picket fence dream somewhere else? It's really skewing the narrative kind of post-COVID, post-2020. So that's a lot of the research that's going to come out in that state webinar. Again, so much more. I'm excited to see that final product too.
Yeah, I think people don't pay enough attention to migration trends. They're always been available, just from like U-Haul has them every year. And they're really interesting to see like where people are moving to or where the most moves are to. Most of them, again, are out of California to somewhere else.
Just straight out.
These types of data are available in smaller areas that you can try to figure out. But it is interesting to think that I always think like, oh, financially, I always think the government, like, how is our country
Yeah,
doing? But I live in New Jersey. I never really wonder or do much research on how's New Jersey doing. I think, as you're saying, that's something really important to understand, that you kind of have to also focus on your state that
right.
has, obviously can handle a lot of stuff on their own. They're not only just beholden to the federal government. The state has its own budget
Yeah,
and pros and cons. So that's something that I think people might want to look into more as well. How's my state doing overall? Like you said, pension funds, all of those things that could be backlogged. It's
right.
interesting to know.
It is. And I mean, taxes, right? If we do see trouble like this, something has to give. It's either less government spending. Well, that I think has to happen either way, but is it an increase in taxes? Where can states draw from that? Again, I live in New Hampshire. We have no income tax and no sales tax. It's all essentially property taxes here. And so that's a very different dynamic than other states that have a different mix, right? We have kind of different focuses of where that money flows to, whether it's state or local, like education. There are a lot of very, very different trends. I'm always shocked when I talk to, like my best friend is from California, and just hearing how different their tax structure is compared to
Yeah.
mine. I don't think we could go farther on two ends of the spectrum from California to New Hampshire. But that matters, right? If you look at your own kind of personal financial situation, where do I want to be positioned coming into somewhere like 2030? Could my state jurisdiction make a difference? In a lot of cases, it can make a very big difference.
Yeah, I mean, I think it's really important for real estate investors to think, because a lot of people have adjusted to out of state investing and figured that
Yeah.
out. But now it's like you really want to be doing due diligence on the overall viability of the state for the
Yes,
long term and seeing which direction it's going to. And then you can, obviously go macro and go down to the bigger cities to see which way that's going. But
exactly.
yeah, I can see where I mean, Texas and Florida are interesting because they're always kind of the highs and the lows.
Yeah.
You were mentioning that they were in a good position, but also they had the backlog of inventory on those overbuilt multifamily or overbuilt, single family homes as well, because when it's booming and then it stops booming and it's just like goes dry in both of those states.
That's the problem. I swear, I don't know where they're possibly building houses in Florida. I feel like every square inch of usable land must have been
Everglades.
taken
Yeah.
up by this point. Like, what are you filling in to keep
Yeah.
building there?
Yeah.
Some of those trends, I mean, Florida just dwarfs the rest of the country in terms of construction levels. Again, over time, kind of cumulatively,
Yeah.
it's just year
Yeah.
after year after year. So, yes, that's a great point. What risk tolerance do you have? Is it somewhere a little more steady Eddie? That's a choice as well.
Yeah. I mean, where can somebody go to give themselves that education? I mean, obviously they can go on ITR Economics.
Yeah.
I love the mailing list though. Like I get very addicted to data. So when I look through it's high end, it's
Yeah.
high end. So I think you really have to kind of be up for the educational challenge of really getting into it, but it can really help. But for somebody who's just trying to figure out, they want to buy their next multifamily, they live in California or something, so they're not buying in
Yeah,
their area, but so they have 49 other states to choose from.
we do.
Where can they look just on their own to start to figure out what's going to be a good buy for the next past 2030 if they're thinking long term?
Yeah. So if you do want us to help you parse through the information, you mentioned we have a mailing list. We actually have a lot of blog posts, and we have
Yeah.
nothing like this kind of podcast, but we have short, like 5 to 7 minute podcasts that come out a few times a week. You can catch them on our YouTube channel or
Yeah.
Spotify, wherever you get a podcast. My colleague Taylor does one called Trends Talk, which is really interesting. If you're just here for rates, that would be me. I do Fed Watch, comes out every Friday.
Right.
So again, if you want to be just like quick hits, it's 5 to 7 minutes. You don't have to go super deep into the Fed and monetary policy and all that. But if you did want to do this on your own, these are publicly available data sets. I would start personally. It's a silly name, but it's called Fred. And so if you go to
we talked about it last time. Yeah.
We did, right? I love Fred.
Yeah.
I'm always on there, but the Census Bureau puts out information. Bureau of Labor Statistics, you're going to get some of that segmented information. It's just a matter of what do you have time to kind of parse through and see what really is out there, what really is going on, state to state level. That's where I would start, just poking around, just familiarize yourself with some of these localities and some of the trends, again, especially consumer trends. That's really what's going to drive the train for a lot of these areas. But Census Bureau has some good ones. BLS, Fred will point you to every type of government data set that there is.
Yeah, I went down that rabbit hole. Thanks a lot. But I mean, if you look at the title of your first episode, which starts with unbiased and apolitical, I think that's what's important because we live in a very political frenzy type of situation now. A lot of people on both sides are very fanatical about whichever way they're going. And then there's a giant middle, but also to be able to, if you really want to forecast and help yourself for the future, you want to remove the politicalness of what you're trying to do with finances. You really want to see, like, because that's the only thing that's going to help you and your family is to just kind of separate that, look at data and learn to understand the data and how it can affect you wherever you are, because it can affect you differently depending on what tax bracket you're in, what state you're in, and what type of holdings you have and how you've prepared those holdings for the future, right?
Absolutely. And that's why I think it matters where you get your information, right? If it's coming from one of these major government sources that I listed, those are nonpartisan, right? Those are apolitical sources that just collect the information and put it out. I know some of them have come under political fire recently. We still trust the quality of data that's coming out of the Bureau of Labor Statistics, for example. Now, if you are being sold not just the data itself, but the conclusion, that's where I would like people to start saying, all right, why am I being sold this? Is it because they're trying to sell me a newspaper or get eyeballs on their, screen? Is it because they're trying to sell me someone to vote for, a political party, a conclusion in that sense of which party's better? That's where I'm going to start to draw some hesitation, I guess, let's say. Everyone is giving you information for a reason. We're doing it because we're economists, like we're nerds. We just want more information out in the world. But also because we want to help people make good decisions. So that's why the unbiased nature is really, really critical.
Yeah, I just think it's worth people spending the time, even if it seems like it's going to be a little bit over their heads, to just get in a little bit deeper on something that can, maybe it flushes out an idea that then you can go do research more. Maybe you go on Fred and you find, as I did, it's pretty overwhelming. There's a lot of stuff to look at, but you get a good broad sense of where you can go next to help yourself. And don't you think part of this and part of what you guys do, and especially with your speaking, you're trying to give people more agency over their financial future? I mean, that's what economists can really help with. Obviously, it's broad scale for a country and for everybody, but for one person to take from it, they can really use what's coming out from economists to just then take it, make it their own, and work on it so it can, protect themselves for what may be coming in advance, like we've been saying.
I agree. And, I know this doesn't sound like a popular line right now, but I really do believe that making the world of business stronger is making the world better in a way, right? It's giving people that stability, that if your job is secure, if your company is making the right decisions to support you going forward, I think that makes the world a better place. I know that sounds a little Pollyanna, but
we
that's
need
really
a little more Pollyanna right now, right?
We all could be a little bit.
Just a little, yeah.
But so many of my colleagues here at ITR just really fundamentally believe that we want to help businesses because that helps people, real people, and because that helps the world. So we are, like I said, completely apolitical. We are not in this to sell you a position or a candidate or anything like that. And anyone who is, I think you have to look really closely at where they're getting their data, because we can cherry pick data if we wanted to.
Yeah.
We could go out there and find the right things, but we don't. That's not why we're in business.
Yeah, and I think it's also good to highlight, we're talking about unbiased and apolitical, but I also find it, and this is the reason why I connected you when I saw you on Bigger Pockets a few years ago, the one when we were in Mexico, and the first thing you said was robot, which is why I always say that. I was like, oh yeah, somebody unemotional like me, like a really, because for me, of course, I'm emotional about my kids. Sometimes I watch a weird Hallmark special. I'm like, oh, that's pretty sad. But when it comes to the data, I'm able to really lock in. And I think it's really hard for people to remove the emotion from real estate and finances. But if you want to plan right for the future, especially when you're judging where I'm going to make a next huge investment, $500,000 or more, you have to start to remove the emotion from it, because it will always cloud our judgment. It's clouded real estate judgment for years, ego and emotion.
Absolutely. Ego and emotion. I think the two sides of it. And again, I see why. You mentioned you get emotional about your kids. Yes, this is their future, right?
Yeah.
You're doing this for them to set up success for yourself and your family. And So I do understand why it's emotional. And I have been accused of being a robot. I've been accused of so many things as an
Yeah.
economist. I was talking about the war in Iran, and I started getting hate mail for being a warmonger. And all I
Yeah.
said is that war tends to be economically stimulative, which is true, right? I'm not trying to take that humanitarian position.
Yeah.
I vote how I vote. I don't tell anyone because that doesn't matter. I vote on, the issues that I find most pressing. I don't think either party is better or worse for the economy because over time that has not proven to be true. I just need that evidence. And so that's why I do want people to take their emotions out of it. There's a place for that, right? That is between you and the ballot box. That is between you and, what do you prioritize for your family? I don't always make the most logical decisions because we're still going to splurge on the vacation when it matters, right? The silly things that really do matter, they absolutely matter.
Yeah.
However, when you're talking about these big decisions that can have long-lasting implications, that's where you need to go into robot mode sometimes.
Yeah. But it's interesting, though, because we were talking before about the data centers and coming into town. And I really see the emotional impact for people when I'm watching some of the hearings or some of the news. Like, it makes sense because it's just an interesting time because there is so many pros, but it's like we're not really sure. So you can't tell me that it's going to be great to drop that in my backyard. However, for the developer, it's an interesting conundrum because they're still trying to help. They have a lot of people who want to build that, but they're getting pushback and they're caught in the middle. As a developer, someone who owns a big piece of industrial, like, wow, this can really help. But now, it's the lifelong conundrum of like industrialism, really.
Really? Yes, it is. It's capitalism in a nutshell.
Yeah. Okay. Before we hop off, at the end of last one, I asked you personally what you're doing to prepare. But what would be one piece of advice that you can leave everyone with that we haven't covered? Obviously, we've talked about personal agency, getting unbiased data. That's important. But what's one more tidbit that you could leave people with? Obviously, you have the economist lens on, but we've gone over so many things. I always want to give them something smart that they can really focus on now because we still have a lot of time to prepare.
We do. And I think mine actually today specifically does relate to real estate. This is going to be different for different individuals. But if you are, again, depending on your own kind of age and family structure, my kid is younger. And so I'm not buying her a house today. But if you do have, I get so many questions, like my kids are college age or going to be, in their 20s, 30s by the time 2030 comes around. Do they buy a house now? I think if you can help your family set up, it's not just you, because I like to say they know where you live and they know that they can move into your basement if everything goes wrong. You're kind of helping yourself here. So personal agency, but really just getting that message out there that it's not just you that has to prepare. If you're a business owner, right? Are your employees looking to you as kind of that leader and thought leader where do I turn when everything goes wrong? Kids especially do this. To some of us, it's going to be parents. Are they fully reliant on Social Security for their retirement? I mean, that's going to be a dangerous thing. So I would encourage you to kind of take a broader scope, right? What is my not just personal risk, but maybe kind of broader risk mitigation strategy? And who can I talk to ahead of time? Just to be sure, again, I don't want anyone knee-jerk reacting today to this episode, but how can I help someone else come up with a plan? Do we need financial advisors through this to help us get into those less risky assets, things that will be maybe more safe haven during the downside? Don't just protect yourself, but protect your immediate community too.
Yeah. And I think just going off that, I mean, I think we've seen a lot, at least in my area, a lot more multi-generational living just across the board. And I think that's going to keep going that way because it's nice and everyone's lonely and we need more family. They don't have as many friends. But I mean, my son lives in a detached accessory dwelling unit above my garage. My daughter lived there before. And I was ahead thinking, like you were saying, I bought my daughter a house last year. Maybe she moves, but it's a house. So I know it's an investment. It's been investment property. If she moves, then I can figure out what I want to do with it. But at least in my opinion, I still look at real estate the way that my dad did. It's a great portal. If you just sit on it and hold it, it's likely to appreciate it. If you improve it, it's going to appreciate even more. So if you have the opportunity to get something in there for your kids, it's something to look at. It doesn't mean it's the end all be all, but I wouldn't go the other way that a lot of people don't ever buy homes. Don't worry about your kids. They'll figure it out for themselves. Well, I mean, that's one strategy.
And they will figure it out, but
they have to.
They're going to have to.
Yeah.
But I don't know. I think we all want to see them succeed. So.
Yeah. Let's hope the best for us for 2030. But I appreciate you coming back on and giving us more insight. Best place for people to find you and your company is itreconomics.com.
That is the best place. Yes. And we have all kinds of social media. Find us again, LinkedIn, YouTube, the usuals. We have a lot of different ways to connect with us. Please reach out if we can help answer any questions, provide any data.
Yeah, I suggest everyone sign up for the mailing list. You got to sit down and read it. Like it's a tall order, but you're going to learn a lot. All right, Lauren, thanks so much for coming back.
It's been a pleasure. Thank you.
Yep. All right. That was Lauren Saidel-Baker of ITR Economics. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 357 of Zen and the Art of Real Estate Investing. And we're not taking notes, we're talking notes with Scott Carson, President and CEO of We Close Notes. He's been in the mortgage finance and banking industry since 2001 and an active investor since 2002. He's been buying notes on residential and commercial properties since 2005. So get your notes ready. It's time. See you next episode.